Welcome everyone. It's great to have you with us for our first IFRS 17 webinar. We'll be hosting 4 more later this year. My name's Marnus Fourie. I'm a partner with the BDO Financial Services Division and I specialize in insurance. Before we dive into the complex world of IFRS 17, allow me to tell you a bit more about BDO and the BDO Financial Services Division. Londi, if you can go to the next slide for me. Our agenda for today is I'll take you through an introduction, then we'll have the technical accounting and some lessons learned from the actuarial considerations. We'll then be joined by Daryl Senick from BDO Canada, who will take us through the technology and the practical considerations, and then we'll dive into half an hour of Q&A. Next slide, please. I think it's important for those of you who are familiar with us and those who do not know us to give you a bit more background about how BDO has grown in the past 18 months. BDO globally and in South Africa is the fastest growing firm and we have a staff complement in South Africa of 1,733 people, up from 750 a mere 2 years ago. Internationally, we have over 88,000 people working for us in 1,617 offices. During the past 18 months, the firm has grown from a medium-sized firm into a major player in the South African professional services industry. We've joined forces with the 3 largest Grant Thornton offices, namely Johannesburg, Cape Town, and Durban, and we've established a financial services business unit. BDO continues to attract a large number of skilled and experienced partners and managers. Our group of 47 specialized financial services partners and managers have over 400 years of experience amongst us. We have been fortunate that we can employ the right people with the right specialized skills and experience, and more importantly, people that have the right cultural fit for our business. Our teams operate in a fully integrated manner with audit and/or advisory, technical accounting, and our financial services technology teams working together seamlessly on engagements. In fact, 1/3 of our new first-year intakes are IT science majors. This is to support the increasingly technology-focused manner in which we aim to deliver our service to our clients. If you can go to the next slide for me, please, Londi. The BDO Financial Services insurance sector has 5 partners and 5 managers that are able to deliver on our insurance engagements. The partners are Serena Ho, Suleman, Bianca Pretorius, Adam Walden, and myself. And some of our former and current clients include a wide range of medium and smaller insurers in South Africa, as well as Hollard Life Insurance, Munich Re, Liberty Life, and Auto and General Insurance Company. But back to what you are here for, IFRS 17. The aim of today is to provide you with a brief overview of some of the potential pitfalls when implementing IFRS 17 across accounting, data and tech, and actuarial. So if you can go to the next slide for me, Londi. We will expand on each of these topics individually over the next few months, as I mentioned earlier. But with you today, we have 5 highly skilled, qualified, and hopefully mildly entertaining panelists. We've got Shehnaaz Suleman, who's an IFRS Technical Associate Director with BDO South Africa. We've got David Kirk, who's the Principal and Practice Leader for Milliman in Africa. We've got Daryl Senick, who is a partner in IT Solutions, BDO Canada. Mark Spencer, who is the Accounting Advisory Leader, Financial Services, BDO UK. And then Neville Moodley, who's a partner and the head of BDO Financial Services Technology. Just some housekeeping matters. We will have a presentation for approximately an hour. For those of you who wish to have CPD or get a CPD certificate, You please need to, there is a survey that will be posted that you please need to indicate that. I believe you need to do it at the beginning whilst we start now. Londiwe will post that, as well as at the end, so there's evidence of you being with us for the entire hour. I encourage you to type your questions in the text box. These will be, can either be named or anonymous, and they will be addressed at the end of the presentation. And we will also post the contact details, our contact details towards the end of the event. So if we can go to the next slide then. So some of the key challenges that we believe insurers are facing in the current environment. We talk about accounting principles. One example would be that of deferred acquisition cost. As of April 2020, the ISB discussed this topic and guidance on the DAC was not finalized. Despite this uncertainty, we believe teams should land on an informed decision to document the interpretation of the existing guidance, how it's been applied, and then there is a risk of later changes. This allows the project to move forward, and the specific areas identified or interpretations made can be revisited as the industry practice develops. Secondly, the coming together of actuarial, technology and finance teams is really challenging the existing reporting operating model. This impact is usually felt across the entire organization, and the introduction of new financial reporting metrics will result in new KPIs, a potential challenge to the short and long-term management incentives. IFRS 17's roll forward mechanism for disclosure results in reconciliation differences between the amounts in your general ledger, cash flows, and actuarial valuation. Insurers will not be able to produce financial statements that balance and are internally consistent. The solution involves greater collaboration between accounting and actuarial functions to move away from the legacy approach that was applied with limited alignment to a more cohesive, aligned, and fresh approach. And then lastly, but certainly not least, data and the quality thereof. The biggest driving factor leading to delays in implementation of IFRS 17 are these two matters. You are likely to have surprises when you start getting into the detail. It's only when you perform a detailed analysis that you are able to identify where the root causes impacting data are coming from. It's extremely important to analyze data and to understand any gaps identified as soon as possible. The systems needs to be upgraded to a more dynamic, agile, and future-proof solution. The overriding factor for all of these is it's important that adequate audit trails and evidence is kept to be able to prove this once your auditors and assurance providers do come and look at these. Before I hand over to Shehnaaz, if we can go to the next slide. When you registered, we asked you a couple of questions, and this is the feedback we received. So the column that talks about total percentage deals with the answers we had in terms of where people are on their journey. And then the three columns to the right is where we asked you, how do you plan to implement, or how have you implemented your transition journey? So with a combination, it's interesting to see that the further people go along the journey, the more they migrate to a combined approach, whereas those who have indicated they haven't started has given us a wide variety of answers. And with that, I'm going to hand over to Shehnaaz Suleman, which will be supported by Mark Spencer to take you through the accounting part of this presentation.
Thank you, Marnus. Good afternoon, everyone. It's quite a challenge to summarize the highlights of IFRS 17 into 20 minutes, but I will do my best. So a good starting point is to really just understand the journey. Where are we now? So IFRS 17 was issued in May 2017, and it had an initial implementation date of 1 Jan 2021. Then this was moved out to 1 Jan 2022, and now in light of recent developments and to give insurers more time to adopt the standard appropriately and really improve the quality, the consistency and the comparability of accounting for insurance contracts, this date has now been moved out to 1 Jan 2023. So the standard is effective for annual periods beginning on or after 1 January 2023. And for entities with a December year end, this means they will be reporting IFRS 17 numbers for the first time as at 31 December 2023. They'll also have to worry about interim reporting as at June 2023, and already they'll have to look at the impact on their comparatives for 2022. So as much as it may seem like it's far away, it's really creeping up and there's a lot of work to be done. The last point I want to mention on this is that when the board extended the effective date of IFRS 17 to 1 January 2023, they also extended the exemption that's currently in place for adopting IFRS 9. So certain insurers have elected to apply IFRS 9 when they go live with IFRS 17, and they will then also have that opportunity to defer up adopting IFRS 9 as well. So I'm going to move on to the next slide, where we talk a little bit about the differences overall in terms of IFRS 4 and IFRS 17. It's really just to set the scene and not to get into too much of the detail, but IFRS 4 was an interim standard that was published to help insurers account for their insurance contracts and the obligations that arose from that. It did not mandate a specific measurement model, whereas under IFRS 17, there's measurement models that are in place that are available for insurers to adopt. And IFRS 17 is going to be a first truly global framework that insurers can use in accounting for insurance contracts. And we're hoping that this will then result in an increase in global comparability and really enhance the quality of the financial information. This information will be very useful for investors and analysts to really understand insurers' expectations about future profitability, what risks the insurers are facing, and how those risks impact the changes in the insurers' obligations. So that's just giving you some of the key differentiators, and there's more detailed requirements under IFRS 17, the need to delve deeper into more granular information. So these are our work is cut out for us, but it's not to worry too much. There's always support nearby. So we're going to move on to just a very quick recap and overview of the types of measurement models. Right, this is a big part of IFRS 17. The intention is not to get into the detail, but really just set the scene for what comes next. So there's three measurement models that are available in IFRS 17, and I'm just going to run you very quickly high level through the different models. So the first model is the general measurement model. It is a default measurement model, and you may also hear it being referenced to as the building blocks approach. This will be used for many insurance contracts which have contract boundaries that are greater than 1 year. Typically, this will apply to life insurance contracts which don't have any participating features. The second model is the premium allocation approach. This is a simplified measurement approach which is available for contracts with a shorter duration. For example, non-life contracts or property and casualty, what we typically refer to as P&C insurance type contracts. Now, entities are allowed to apply this approach if either of one of the two criteria are met. If the entity reasonably expects the results of applying the simplified approach would not differ materially from that what you would get under the general measurement model, or if the coverage period of each contract in the group is 1 year or less. So if you check either of those boxes, easy peasy, you can apply premium allocation approach. The third model is a variable fee approach, which a lot of people refer to as VFA, and it's intended to be used for insurance contracts which have a profit contract element and that has a direct participation feature. Now, in applying these measurement models, we're going to move on next to really what are some of the practical considerations that you need to look out for. So first up, you'll notice I kept it short and sweet on my slide because I'm not going to write you lots of stories. I'm going to talk you through the principles. Hopefully, this will be helpful. So first up, we're going to talk a little bit about cashback products. And this really relates to policies that have a cashback benefit feature. Traditionally, these types of policies would have a shorter time frame, so either they're renewable annually or monthly, and they would then have a shorter contract boundary, 12 months or less, and would be eligible to fall within the premium allocation approach, which is a little easier to apply than the general measurement approach. So they would automatically qualify for the simplified approach. Now, when you think about this cashback benefit feature, it typically would mean a policyholder would need to remain claim-free for a few years, and then they would be eligible to get some sort of cashback benefit at the end of that period. This causes uncertainty regarding that contract boundary element, because now IFRS 17 gives guidance to say when you're determining contract boundaries, they are determined as either the period in which the insurer can compel the policyholder to pay premiums, or, wait for it, the period at which a substantive obligation to the policyholder ends. Now, if the insurer may have to pay an amount to the policyholder at some point in the future, questions come up to say, well, when does the obligation to the policyholder really end? And this really results in this type of a product being kicked out of being able to apply the premium allocation approach and then having to apply the general measurement model, which is quite onerous and becomes significantly more complex. So that's just one typical element we would see, and it's quite popular in a South African context, and that's something to watch out for. The next thing I want to talk about is where we have significant judgments and estimates. Sorry, Londi, please can you go one back? This is quite a long story on practical considerations. You might want to get the popcorn. So let's go back to significant judgments and estimates. This is particularly important because there's a lot of emphasis placed on and discussion on fair value determination under IFRS 17 and where you have to do fair values. And when it comes to fair values in insurance, it's a little bit tricky because insurance contracts, they're not really traded on an active market. So this becomes quite a big judgmental area, and there's estimates that are used in that process. And there'll have to be information that's disclosed on that. So this is something that's going to have to be given a lot of attention in the disclosures, in the processes, and an entity would need to disclose information about those significant judgments, specifically relating to the methods used to measure the insurance contract and the process for estimating the inputs into those methods. That could be quantitative, qualitative, and it would depend on what information you have available. Any changes to those methods and processes for estimating those inputs would also need to be disclosed with the reason for each change and the type of contracts that have been affected. Other information that would need to be disclosed as a significant judgment would typically also relate to your discount rate or any investment component. Next up, I want to talk a little bit about accounting policy choices. So in a lot of the new standards, accounting policy choices do pop up. And I'm just going to mention two, but you'll see there's a whole lot of accounting policy choices that IFRS 17 offers. So first up, an entity can choose as its accounting policy to present the insurance finance income or expense in profit or loss in its entirety, or they can disaggregate it between profit or loss and OCI, subject to certain requirements, but once chosen, that accounting policy will need to be applied consistently at the level of a portfolio of insurance contracts. So that's quite an important one, and there's also been a lot of discussion about how that would work in practice. Next up, I want to talk about acquisition cash flows. So typically insurers do incur costs upfront to acquire that insurance contract, and that's referred to as the acquisition cost, which a lot of the time is deferred over the term of that insurance contract. Effectively, it reduces the liability recognized on initial recognition and kind of spreads the expense over time. However, if the coverage period of each contract in a group of contracts on initial recognition is 1 year or less, then an entity may choose to recognize those insurance acquisition cash flows as an expense when they're incurred. So that one is popular, and there's a lot of questions that we get on the technical accounting front relating to deferred acquisition costs. It's something to definitely consider. Next up, we're going to talk a little bit about levels of aggregation. So under IFRS 17, a company is allowed to apply the requirements of IFRS 17 to a group of contracts rather than on a contract by contract basis. The level of aggregation is quite important because it deals with grouping individual insurance contracts for the purposes of either recognizing losses when a group of contracts becomes onerous, so those losses will be recognized upfront, and the timing of the recognition of profits arising from a group of profitable contracts. So when the group of contracts is profitable, that profit is then spread over the term of those contracts. And there's 3 factors to consider when determining what is the appropriate level of aggregation. So the first one is portfolio, the second factor is profitability, and the third factor is the time of issuance of the contract. Now this is really critical, and entities would rather spend time upfront getting the level of aggregation correct because it then has a knock-on impact on the measurements that follow. So portfolio starting point for aggregating contracts is to identify portfolios of insurance contracts. Typically, a portfolio would comprise contracts that are subject to similar risks and are managed together. This aggregation of the insurance contract would be done upfront when the contract is issued and is not subsequently revisited. Next up, we'd consider profitability. Insurance contracts need to be then grouped into contracts that are onerous, those contracts that have no significant possibility of becoming onerous, and the remaining insurance contracts. And that's really to prevent groups of contracts that are making losses from offsetting against groups of contracts that are making profits and distorting the numbers. And then lastly, timing. The timing of when the contract is issued. A group of insurance contracts cannot include contracts that are issued more than 1 year apart. So each portfolio will be disaggregated into what is called an annual cohort, which is like a smaller subgroup of contracts consisting of periods of less than 1 year. Separating those contracts issued more than 1 year apart is a new concept compared to what existing insurers are doing. So this will lead to operational challenges. However, there's some exceptions where relief can be provided on transition. Now, this will mean there'll probably be groups of contracts that are accounted for currently together under IFRS 4 that on transition to IFRS 17 may have to be disaggregated at a lower level. And that may result in recognizing higher liabilities for onerous contracts. After transition to IFRS 17, this will also mean that losses will be recognized in profit or loss immediately for groups of onerous contracts, whereas expected gains on contracts that are not onerous will be deferred in the form of a liability for remaining coverage. So I know that was a mouthful, but it really means that we really need to take time and get that level of aggregation right up front. The next point I want to touch on is really IFRS 17 and how IFRS 17 plays with some of the other standards. So the interaction between IFRS 17 and other standards. So there's certain elements that may be included as part of an insurance contract that don't fall within the scope of IFRS 17. And it's important to analyze what has been promised to the customer and split out any non-insurance components and account for them under the relevant IFRS standard. For example, if there's an embedded derivative within an insurance contract, depending on whether certain criteria are met, this may need to be split out and accounted for separately in terms of IFRS 9. If we look at financial guarantee contracts, unless the issuer of that financial guarantee contract met certain requirements and made an irrevocable election to apply IFRS 17 to the contract upfront, they would be required to account for those financial guarantee contracts under IFRS 9, IFRS 7, and IFRS 32. And then just one more on this funnies that play between different accounting standards. IFRS 17 permits some type of fixed fee service contracts to be excluded from its scope and accounted for under IFRS 15. So there's criteria that needs to be met, but this then allows preparers of financial statements a choice of whether to account for fixed fee service contracts under IFRS 17 or 15. If they're accounted for under IFRS 17, chances are they probably will qualify to fall within the premium allocation approach. And then lastly, just a bit on transition. It's very complex and there's specific rules to consider when transitioning to IFRS 17, but Mark will take you through that in more detail in the next few slides. Moving on, I'm just going to talk a little bit on disclosure requirements for insurers. So if we can just go to the next slide. Perfect. So currently, entities do provide disclosures that are similar to those required by IFRS 17. So there's some current disclosures, for example, the reconciliation of the change in insurance liabilities. But these are typically being made now at a bit of a higher level with little or no disaggregation. The new requirements to IFRS 17 are really going to force insurers to then break those down into more detail, and this is going to speak to the level of aggregation that you would have landed on upfront when you did your assessment. So in addition to what's been highlighted on the screen, one thing I do want to talk about is the reconciliations that will need to be done in terms of IFRS 17. So an entity is now going to have to disclose reconciliations that show how the net carrying amounts relating to insurance contracts changed during the period arising from cash flows and amounts recognized in the statement of financial performance. Separate reconciliations have to be disclosed for insurance contracts issued and reinsurance contracts held. In each reconciliation, the opening and closing net carrying amounts are disclosed, and they have to be disaggregated into a total for groups of contracts that are assets and a total for those that are liabilities. So the recons really have to explain how amounts in the statement of financial position and statement of financial performance are linked, how they move together, and has to provide different types of information about the insurance service result. I mean, some of the other disclosures that will also need to be considered, accounting policies will need to be updated, terminology will need to be updated, practical expedients that are exercised will need to be disclosed. There'll have to be a lot more specific disclosures on transition to explain the transition amounts. On that note, I'm going to hand you over to Mark, who's going to talk to you a bit more on transition. Mark, over to you.
Next slide, please. Thank you, Shehnaaz. And Shehnaaz made reference to popcorn and cinemas. I'm going to make reference to popcorn and cinemas as well by stating that Shehnaaz was very much the leading lady, but I'm the support act. So hopefully both of us will win varying degrees of Oscars. But moving on to transition, there are three methods in terms of transitioning to IFRS 17. The main one, as set out in the standard, is the fully retrospective approach. Now, some of you may be aware that under IFRS 9 financial instruments, IFRS 15 contracts with revenue rec customers, and IFRS 16 leases, they allowed you not to restate the comparatives. However, in some shape or manner, under IFRS 17, you need to restate the comparatives. So, IFRS 17 is effective for annual periods beginning on or after 1st January 2023. you would prepare your December 2022 financial statements using IFRS 4. However, when you come to 1st January 2023, you need to restate those comparatives as if they had always been prepared under IFRS 17 if you are following the fully retrospective approach. So that means you would have an adjustment to your opening retained earnings as at 1st January 2022, which is your date of transition. However, that means that you'd effectively need to rework all of your insurance contracts, both those held and those issued, as if IFRS 17 had always been applied. The ISB acknowledges that this would be challenging in practice, so they have allowed two alternative approaches to transition. However, to be clear, it still requires the application of certain requirements, such as the grouping of insurance contracts, to be performed at the date of transition, which is 1st January 2022, and not the date of initial application, which is 1st January 2023. So, if an insurer cannot apply the fully retrospective approach without using hindsight, therefore, what they can do is one of two things. They can either use the modified retrospective approach, which has some practical expedience when it comes to applying all of the requirements of IFRS 17, such as grouping of contracts being done at the date of transition. And if an insurer cannot apply that, then they need to apply the fair value approach. However, I would urge caution when applying the fair value approach, because what that requires is you to estimate the carrying amount of the insurance contracts, either liabilities or assets for reinsurance held, using IFRS 13's definition of fair value, which is based on a market participant's view of what that fair value is. And this may be challenging in practice because active markets do not exist for insurance contracts. So that means if you were to default to the fair value approach, you would need to unwind a difference between the fair value of the contracts and then subsequent application of IFRS 17 on an ongoing basis, and some of those results may be counterintuitive. Next slide, please. Okay, so as Shehnaaz mentioned earlier, there have been certain amendments that were an exposure draft was issued last year and have since been deliberated in December and January, February, March this year by the ISB. And these change the requirements of IFRS 17 to some extent. Now, depending on how you cut and dice it, there would be 10 or 11 amendments, and we're just going to focus on some of those amendments as part of this presentation. The first is scope. Now, certain contracts may have an insurance element that is created by the contract. For example, certain types of mortgages, whereby if the borrower were to die, the lender would assume the property as satisfaction of the obligation. And that gives rise to insurance risk because it is dependent to an extent on mortality and longevity. Now, under IFRS 17, you'd probably be applying the general measurement model, which is very challenging for such contracts given their very nature. So the ISB has allowed an election as an accounting policy choice to either apply these under IFRS 17 insurance contracts or IFRS 9. A similar amendment has been made for credit cards. However, those need to be accounted for under IFRS 9. Another amendment relates to the presentation of insurance contracts. Now, this does not change the recognition and measurement requirements of IFRS 17. Cash flows still need to be estimated and discounted back to present value using the cash flows for those group of contracts. However, what this amendment allows is for an insurer to group those contracts for presentation purposes only based on the portfolio of insurance contracts. So this means that they would not need to follow through all of the aggregations in terms of cash flows. The third type of amendment that we're going to be talking on as part of this webinar relates to the risk mitigation option. Now, the risk mitigation option is there for insurers to basically differentiate in terms of how they account for the time value of money. Traditionally, that would be running through your insurance finance income and expense. However, to achieve a degree of matching with IFRS 9, then it may be measured through OCI. So that means if you're measuring your financial assets at fair value through OCI, you would have a degree of symmetry between the financial assets and the liabilities in terms of time value of money. And there have been various amendments to IFRS 17 in terms of the risk mitigation option. And that basically widens the extent of it, for example, if you're using derivatives to hedge certain risks associated with the insurance contracts. Next slide, please. Next slide, please. Okay, there are some more amendments when it comes to IFRS 17. One of these relates to classification of insurance contracts. And what this means is that typically when you were to acquire insurance contracts, you would need to assess that as a new insurance contract. And this could mean that you could have an insurance contract whereby that contract is showing as being in its liability for incurred claims period for the purposes of the acquired entity, but in the books of the acquirer, because you restart the clock when it comes to IFRS 17, you need to measure it in terms of liability for remaining coverage. And this amendment allows you to effectively grandfather this insurance contract in terms of recognition and measurement, so it is always in the incurred claims phase. However, you would still need to assess as to whether that contract is an insurance contract for classification purposes as at the point in time of acquisition. And also, similar to the risk mitigation option that I was talking about on the previous slide, the ISB has also proposed a similar amendment in terms of transition. So that means this risk mitigation option can be applied at transition if certain requirements are in place as at the date of transition, because previously this was not permissible. And this draws a close to the accounting section of this presentation, and I'll now hand over to Daryl, I believe, who's going to talk about the actuarial aspects. Thank you.
Right, thanks, Mark. Let's move on to the next slide. And one of the questions that I often get asked is, well, isn't this actually just a life insurance project? So I think that is the elephant in the room. We talk all about the complexity that's required in terms of adopting IFRS 17. I think Shehnaaz did quite a good job of showing the complexity around that. One more slide, please. And I think you certainly could argue that for a life insurer, this is typically going to be significantly more complex than for a non-life insurer. But I think as you unpack this, some more wrinkles come into play. So if you are a non-life insurer, and you are confident that now and forevermore you're only going to be writing short duration contracts where the premium allocation approach is sensible, you don't have any cashback benefits or options, you may well find that IFRS 17 is a relatively easy project to implement. In fact, on the other hand, there will be certain life insurers where their product mix says that they can also adopt the premium allocation approach. And then again, while it isn't a non-issue, certainly some of the complexity does fall away. But usually my advice is that you actually need to make sure you've understood all the details to make sure you don't start looking at a baby elephant. And then as the project emerges, you realize that maybe this is more of a full-size grown elephant, and then you need to move on from there. Let's have the next slide, please. So from an overall actuarial perspective, or from an implementation perspective, really just looking at more calculations, more assumptions, more interactions, and a whole range of different impacts. You are going to need to have robust cash flow models. Some of you may have these models. If you're a non-life insurer, you may not have any of these models, even for your claims provisioning, and you're going to need to have those in order to do the discounting of those cash flows, or at least to demonstrate that those impacts aren't going to be material. You're going to have to make some real decisions around your risk margin as well in that case. Now, for many insurers that already have cash flow models, they realize that now is maybe a good time to be adapting those, to be refining them. And the additional time that we have in terms of adoption has given some insurers the thought that maybe there should be less of a minimum compliance project, and maybe they should start looking at, well, how could we enhance our modeling capabilities to get some more business value out of these? At the same time, I think probably most insurers now have been recognizing that while some of the cash flow models will still retain as an internal modeling capability, third-party or external providers of IFRS 17 solutions might be appropriate. And that, there's a range of them. That could be something from Moody's or Fizz or a SAP. It could be Milliman Mind or Milliman Integrate, and BDO has their own solutions. And I think Daryl later on is going to talk a little bit more in detail about some of how those systems work. For life insurers, some of the real pain here comes in the increasingly granular details you're going to need for setting assumptions. You're going to have to set assumptions and bases for cohorts of policies, and then if those are 10 and 20-year policies, you're going to need to maintain those bases over extended periods of time. The CSM calculation, the contractual service margin, is a brand new idea to many of us in South Africa. If you've ever had any exposure to US GAAP, there are some similar ideas there, but that is a brand new approach for us. It's brand new models, brand new calculations, and the data storage requirements and modeling that over time are really, really crucial. In terms of the impact on the financial statements, the pattern of profit recognition can be totally different. And what's tricky is that we can't even say whether there is going to be more profit upfront or less profit upfront compared to what you did before. IFRS 4 has been very lenient in terms of how you actually apply the principles. So you could have had an extremely conservative approach, taking zero credit for future cash flows, incurring those acquisition costs upfront, and having losses upfront and fairly significant profits down the line. Other insurers would be taking the maximum possible profits upfront, having fairly aggressive accounting policies, and for them the change is going to be actually quite uncomfortable. They're going to have to look to a much slower recognition of profit over time. The source of discretion that we had before in terms of whether you would zeroize negatives, whether you apply different types of margins, maybe a little bit of fuzziness around how you'd apply your accounting policy changes, those all fall by the wayside. But there are new sources of discretion, and Shehnaaz spoke about some of those critical estimates and critical accounting choices that you're going to need to make. What are the size of your cohorts? How do you group those contracts? What are your coverage units, and how are you going to recognize the CSM and in fact the risk margin over time? Are you going to do everything you can to try to adopt the premium allocation approach, or are you going to be sort of forced down into the general model? Those can give fairly different results at different times, and those are pretty crucial decisions. Where I've been involved in guiding clients down this process, you try to make the fundamental decisions first, but ultimately, 6 months, even a year down the line, with additional information, additional practical insights, you can realize that you may need to revisit those assumptions. So yeah, we have a bit more time, but certainly there's no time to waste. And then we haven't really worried too much about OCI in terms of certainly the way I've looked at insurers in the past. But now we have some fairly key decisions around what's going to go through profit and loss, what's going to go through OCI, and how do these interact. So that can really change things a lot. And in this slide, I haven't even talked about the fact that what even is considered as revenue could be a very, very different creature from what we used to in the past. Let's move on to the next slide. And this slide is called Some Common Problems Have Emerged, but it actually should be that, some of the common problems that have emerged. I have a list of about 100 of fairly typical things that come across. Here are just 8 of them, and I'm going to talk about them in a little bit of detail. Now, what's not covered here is transition. I think Mark's covered at least just some of the complexity there, and that can really be a major headache and a major source of decisions that needs to be made. Also haven't touched much on data, although the data requirements are absolutely significant. I think Daryl later on will describe some of the possible solutions to dealing with the huge amounts of data, the granular amounts of data that you need. And I'm also not really talking about the systems, which I think Daryl will cover as well. So there's a lot more that we could have spoken about here. Shehnaaz introduced the idea of contract boundaries. What I'm going to focus on here is the fact that we could have different contract boundaries between solvency assessment and manage, or our regulatory liabilities, and what we have on an IFRS perspective. Now, sometimes it comes as a bit of a shock because some of the principles are pretty similar, but one key example would be funeral contracts, where you have the ability to terminate unilaterally with 30 days notice. Now, I know there has been some news about insurers, and there's been a bit of debate around what your terms say, what your marketing says, what the policyholder protection rules say. But if you do have the ability to terminate within 30 days notice, you're going to almost certainly end up with a very short contract boundary under IFRS. But under SAM, if there is an element of pre-funding, if you have level premiums for increasing risk over time, my understanding is that you are likely going to end up with a long contract boundary and having a very, very different contract boundary between the two. Now, where there is some discretion here, you may want to weigh up, the pros and cons of each, and also the potential benefits of having an aligned contract boundary between SAM and IFRS, rather than have even further reconciliations between these two bases. Shehnaaz covered cashback provisions a little bit, so I don't have too much to say there, except just maybe to highlight that these products are a fairly fundamental part of our non-life insurance market in South Africa, and they are a lot less prevalent globally. So the extent of guidance and support and discussion of these on a global perspective has been pretty limited. So, we've had to deal with some of those and grapple with some of those issues ourselves. And although there do seem to be different approaches that are being recommended, it seems clear that everybody is saying that this should not directly affect your contract boundary, and you need to allow for a provision for these cashbacks elsewhere, potentially on a claims provision sort of basis. Your treatment of acquisition costs, whether you're able to defer them beyond the contract boundary, your extent of what are directly attributable versus non-directly attributable, how you manage to offset profits from reinsurance against loss-making business. There are a ton of decisions here where your business model can actually affect how profit and loss comes out of it. The next one on inconvenient knowledge is one that I've struggled with a few clients recently. The idea of showing loss-making contracts as loss-making upfront. And if you have, again, maybe say with the example of funeral policies, we know that people in KZN experience higher mortality than people in the Western Cape, but we typically don't price on that. Now, do we close our eyes and pretend we don't know that, and that we don't actually show all those policies written in KZN as loss-making? That gets to be quite an uncomfortable position. Reinsurance, in fact, there have been some recent proposed changes on the treatment of reinsurance. So that's also an area to keep an eye on. Inwards reinsurance can be particularly complex, again, around things like contract boundaries and anticipating the level of volumes of business. In terms of volatility, some argue that IFRS 17 in general is going to reduce accounting volatility. I think that depends a lot on what you were doing before. But just to highlight that your claims provisions are going to be a source of volatility. Potentially your provisions for cashback can be a source of claims volatility. And even something like group PHI, where I really struggle with the fact that you have a short contract boundary, even though you're going to have a 10 or 15 or 20-year period of risk without any contractual service margin on those claims provisions to absorb losses. So again, you can have source of volatility popping up from some unexpected areas. Now, we have the ability to choose how we deal with our economic changes, whether we put it through profit and loss or through OCI, but we need to be consistent between our assets and our liabilities. And it really can be quite a fundamental choice. I would expect most people who are closely matched and are actively matching to want to put everything through profit and loss, and those who are less well matched and maybe trade less in less liquid markets, and this is very true of life insurance on our continent, but outside of South Africa, might choose to put that through OCI. And then the variable fee approach, happy to take questions on that, but I think I'm not going to delve into too much detail, but there is a lot of complexity there, and quite a few of the recent amendments do talk to the variable fee approach. This is mostly going to be applicable for with profits or universal life business. So if you don't have those products, at least that you can be happy on. That was my whirlwind tour of some of the common problems that have emerged, and I'll hand to Daryl now, I believe.
Thanks, David. That was great. As you can see, there's a lot of information to digest, and if we go to the next slide, I'm going to take you through a journey around the IT landscape. Can we progress to the next slide, please? Next slide, please. Yep, there we are. In supporting a number of insurers, we have come to learn that IFRS 17 is not your typical project. Its scope is much broader, its impact is much more significant, and the level of expertise required is very high. Insurers have been wrestling with a number of challenges within their IT infrastructure, and then along comes IFRS 17, and it really intersects a number of systems and capabilities within the IT landscape. We have seen a number of challenges related to systems agility, data connectedness, and the fact that many of the systems in play are actually considered black boxes, limiting control from the insurers, further complicating this scenario. Many insurers start with data maturity as a first step, And they do that because they find that those with low data maturity really struggle with the requirements of IFRS 17. It's not all bad news. Many have made advancements in the nature of connecting systems and data together, and that has become a significant enabler for the adoption of IFRS 17. Let's proceed to the next slide. The deferral has really opened up the spectrum of possibilities for IFRS 17, where many insurers were heading down the path of base compliance. They now have the opportunity to consider optimization and transformation type of objectives. We have seen significant opportunities in regards to organizations wanting to optimize and transform their financial and IT processes as a result of IFRS 17. There's significant runway and sufficient runway to combine objectives of IFRS 17 with other business strategies. However, the window is closing and insurers will need to move quickly to accomplish all this. If done right, the foundation for IFRS 17 will serve as the foundation for business optimization and transformation objectives. Insurers generally start with the core IFRS 17 requirements and then layer on those relevant near-term business objectives. These business objectives often include things like financial system evolution, data analytics, and moving into the world of AI. Given the cost and complexity of IFRS 17, many insurers are looking to combine it with other key initiatives to realize economies of scale. A key takeaway from this session is to consider what business objectives in your normal business strategy can be combined with IFRS 17 to ensure the right foundation, the right strategy for IFRS 17 advances forward your business strategies overall. Next slide. No matter the path of IFRS 17 that you take, we often find that it comes back to 5 key elements of a journey to consider. So first off, data connectivity. The ability to connect data across your organization is key to making sure you can meet those requirements for IFRS 17. So data connectivity from the source systems to the actuarial systems and the financial systems is a must. And there needs to be clear auditability and clear control in place for that data connectivity. Next is an IFRS 17 calculation engine. There are many calculations engines in the marketplace. BDO has a calculation engine for the premium allocation approach, but we interface with other calculation engines, and I'll talk about that a little bit later. Financial statements and disclosure. You'll need to update your chart of accounts. You'll need to update your financial systems, and your financial statements and your disclosures will need to be updated and refined as a result of the standard. Management and operational reports. We often find that there is a level of alignment between your financial statements and your operational and management reports that needs to take place, and that is a key consideration for your journey. And then with all this in place, many organizations are saying, how do I make the most of this data? How can I get the best of what I've invested into this infrastructure? And so most are moving into advanced analytics and AI, using IFRS 17 as a catalyst to move into the world of data science. If we go to the next slide. IFRS 17 requires a lot of data, and but insurers are finding it very difficult to get access to the data and connect it all together. We are seeing many issues related to data often trapped into legacy systems, particularly in the life space. There's a lot of legacy systems in play, and data is often trapped within those systems. When data is available, it's often inconsistent in both its meaning and its definition across these systems. There's often a lack of data infrastructure and data architecture to deliver on the requirements of IFRS 17. And so if you are encountering challenges around data quality, data completeness, data accessibility, fit of data for IFRS 17, let's just say you're not alone. Over and over and over again, we see many of our clients wrestling with those challenges, and that's a big part of what we're going to talk about today. There is an opportunity to deliver on the IFRS 17 requirements while significantly maturing and delivering on advanced data workloads within your organization. If we proceed to the next slide. You know, no matter what your IT landscape is, you know, a great data infrastructure really helps with the journey around IFRS 17. So most insurers are asking the question, you know, what is that data infrastructure to connect everything together? And what we have outlined before you is really a sample architecture, a reference architecture that we've used over and over again. You know, the data architecture addresses the core ingestion, integration, storage, calculation, reporting, and analytics requirements most insurers are discovering they need during their IFRS 17 implementations. The data architecture not only addresses the need of IFRS 17, but it also sets the stage, sets the foundation, sets the maturity for moving into advanced workloads. You know, having an organization's customer, claim, policy, financial data sets all into a centralized repository really sets the stage for moving into the world of AI. We have helped a number of clients with taking that valuable data set and establishing AI models to manage risk and helping the underwriting department and helping the sales organization with client lifetime value grow and mature their book of business. Our AI models have allowed organizations to find efficiencies in their day-to-day operations and save costs and increase revenue with time. And so I'd really recommend that organizations take the time to really take a look at their data landscape and set themselves up for the right foundation to move forward. Next slide, please. You know, BDO has been working with the IFRS 17 requirement for a number of years, and internally we have established an accelerator called INSURERS. It's a data accelerator that was born out of a working group amongst our firm and with our clients. It takes the very best practices from the front runners and packages them into an accelerator. It allows an insurer to accelerate the time required to establish the data environment to support IFRS 17. This allows the Office of Operations, Actuarials, and Finance quick access to data so that they can spend more time on managing the business, managing the decisions, making the decisions required to get through the IFRS 17 process. InsureHub includes a core calculation engine, reporting engine, advanced analytics engine to meet the needs of IFRS 17. InsureHub on its own enables the premium allocation approach measurement model, but it also interfaces with industry-leading CSMs for the general model and some of the other measurement models. InsureHub has helped our clients not only prepare for IFRS 17, but really advance their data maturity to set themselves up for advanced analytics and AI. Next slide, please. You know, one of the key benefits of the InsureHub platform is that it establishes a modern data platform to rapidly mature your data environment. InsureHub allows insurers to easily access all types of data internally and externally, and it includes a collection of powerful tools, including dashboarding, scorecarding, data mining, investigation tools, operations insights, management reporting, predictive modeling, and the list goes on and on and on. It incorporates the very best from our industry team, our insurance industry team, and what we have delivered for clients. There are significant data investigation capabilities, and these data investigation capabilities are critical for any AI program. So if you're interested in setting up, getting into the world of AI, one of the things that many organizations fail to do is set up an data investigation capability to support the understanding of what the models are telling them. And so InsureHub has that all built into the platform, and it sets the stage for moving into the world of data science. And finally, at BDO, we have established a particular process and a methodology to really help your IT organization move through the complexities of IFRS 17 quickly. Can we move on to the next slide, please? We have established an approach that helps insurers jumpstart on the journey based on accelerators we have established with the front runners. Most organizations are starting with an end-to-end test pilot to test the impacts of IFRS 17, and then they quickly scale from there. The approach is based on the agile methodology, where you start small, start with a handful of products, deliver quickly, stitch together the end-to-end infrastructure to make IFRS 17 happen, and then test the impacts around that with validating the impacts on your ecosystem and mitigating all of those impacts that come up. Then it's a matter of scaling quickly and scaling across your portfolio. So our recommendation is to start small, 1 or 2 products, stitch together the end-to-end, validate it, ensure the impacts are mitigated, and then scale fast. We find the agile approach works best to mitigate the impacts of IFRS 17 across your organization. And with that, hopefully that shares a bit of the IT impacts that IFRS 17 has for insurers.
Thank you, Daryl, Mark, and David. There's certainly been quite a few questions. I think people have, I won't say entertained, I think they're definitely scared now, and hopefully we can offer them some solutions. So just during the Q&A session, if I can ask you, we will post a survey, or the survey was posted at the beginning by Justine. If you can just look at that survey, if you can complete that for us, and let us know what you would like us to address in the upcoming webinars. If there's any improvements that we can implement for the following webinars. So looking at some of the questions, I'm going to take the first one that was asked about how BDO can assist you on your journey, and in terms of what assistance we can provide and what services we can provide. So we are able to provide you in a modular fashion, and that is across the different disciplines. So we can start with a simple gap analysis. I think supposed to caveat this is it depends on whether you're an existing client and what client of ours you are. But let's assume that you are not a client. Let me give you the full support that we are able to provide. So we can start with a gap analysis. We can do an impact analysis for you and take you through the implementation process. We have the support of both Milliman and IAC from an actuarial point of view in South Africa to look at the data and assumptions. We are able to support you with our, from the IT point of view, with the data. We can help you with the calculation, a vendor selection in terms of the systems. We can assist you with a sub-ledger to general ledger consideration. And then I suppose most importantly, if you enjoyed some of the presentations, and certainly Shehnaaz, Suleman is always a very good presenter, we are able to assist you with training and training up your staff for IFRS 17. I think in broad strokes, that is how BDO is able to assist you. But I think I'm going to go to the next question now. And this question, let me just read it here for you, is question that was posted: to what extent will IFRS 17 will be a useful tool, useful metric in a day-to-day business decision making? So if I can pass that firstly to David, if you can take that one for me.
Yeah, so it is a big question. And I mean, I'm actually, generally speaking, a fan of IFRS 17. I like where it's got to. I think it does remove some of the worst inconsistencies between insurers within a country and from one country to another. I think that the principles make sense and tie back to the same sort of ideas that have been introduced through IFRS 15. There's a lot that is good about it. There is a lot of complexity in putting it all together. And depending on what you're doing before, it may well be a very big change in how you see products and profitability and variability going forward. I think there's naturally an extent to which, well, this is very, very different from what we used to. We got used to the old way. We're going to keep on doing that old way in terms of understanding our product. And I think we need to get a little bit more used to how things might be and what value we could get out of it. If you're sensing a little bit of hesitancy and to have an overarching, yes, everything is going to be great, that's because I do feel that as well. And I suspect many insurers are going to have some other non-GAAP measures. They're going to have some similar items to how they looked at things before. They will look at things like embedded value or Solvency II or SAM numbers, trying to get some value out of that, particularly on kind of what is the value of new business. If you don't like the contract boundaries, or you don't like the renewals, or you don't like the deferrals, you don't like the treatment of expenses, you can get useful results out of it. I'm not convinced that all results are always going to be useful, and I wouldn't be surprised if you did use some other numbers as well. That is an actuary's perspective, and I don't know, Marnus, if you want to get in one of the other guys to see if they agree or disagree.
Yeah, if Neville, and if you can maybe just add to that for me, please.
Thanks, Marnus. I think, around systems as a whole, I think, look, the difficult things that you need to consider at the moment is, do I make the investment? Does it make sense to just invest for purposes of IFRS 17? Probably not. I think from some of the experience I've received previously is that accounting change by its nature is probably driving you in terms of how you should be running your business going forward as well. So you want to use the new systems and use your new data that you've now created for purposes, well, firstly, to sort out your IFRS 17, but secondly, how do I run my business better, have more insights, and then be able to run my business in this new way? And I think we've seen this with changes in accounting standards. I think IFRS 16 is a good example across some of the leasing businesses, where they started on a journey around IFRS 16 compliance and ended up saying, well, we've got all of this data now, how do I run my business better? From the feedback across the market at the moment in South Africa and globally, it's bigger than just compliance with IFRS 7, well, moving to IFRS 17. It's about actually, how do I actually use this data to start making better business decisions, drive the profitability of my business, and be more relevant to the market and more have better data for your decision-making processes. So yeah, that's just my view.
Perfect, thank you. I think moving on to the next one. Mark, if you can take this for me, followed by David. What percentage of the current book will be impacted by the day one adjustment?
Yeah, thanks, Marnus. I mean, it depends very much what an insurer was doing under IFRS 4. Remember, IFRS 4 is a standard that was based on relevance and reliability, but it wasn't prescriptive in terms of how you account for insurance contracts. So it depends what you're doing. IFRS 17 requires losses to be all losses to be recognised up front, but gains are deferred. So if that's something that you were doing under IFRS 4, then I wouldn't expect a large degree of change. I'd also say that the second consideration is how long-term the business is and how large the extent of savings business is to protection business, because I would expect the longer term business to be impacted more by the deferral of gains and the recognition of upfront losses than shorter term business. And also, given its very nature, I'd expect the savings business to be much largely impacted than protection business. However, having said that, clearly, if you've written business during the year and the coverage expires throughout the year, then there would not be a change for those products. So in a nutshell, it depends, which is the answer that an accountant typically likes to give. But it does depend on the insurance product base. And that's why IFRS 17 is so important in terms of starting to address its requirements early, because it is very much driven by the insurance risk written, their duration, and what you're currently doing.
Yeah, it really does depend. If you're a non-life insurer and you're going to be able to adopt the premium allocation approach and your business runs up pretty quickly, yeah, from an overall balance sheet perspective, you may not notice all that much. If you are a life insurer and you have long tail business and you've been capitalizing all the profits except that which you had to put back through compulsory margins, you're probably going to have quite a big difference as well. You're going to have a higher liabilities. You're taking losses more on the nose. Your NAV is going to shrink, and in some ways that can be great because some of those profits that you recognized years gone by, you get to recognize them again in future. You want to make sure you don't pay tax on them twice, but from an earnings perspective, you can have some fun and games going through there. Those insurers, and there are quite a few of them, who would zeroize the negative liabilities under a book of risk business. Well, again, if you're zeroizing at a portfolio level, depending on your mix of profitable and unprofitable contracts and how much of those losses needs to take on the nose now versus putting back profits for future, there could be a modest impact. If you've been zeroizing all negatives at a per policy level, you may actually have some good news and your liabilities may still go down under IFRS 17. So, the answer is it depends, but maybe that's a little bit of a flavor of how the different product mixes can have an impact. The only last thing that I would add there is that if you go against Mark's advice and you go for the fair value transition method, and I really lend my voice to Mark, please don't, you could well end up with a very, very big change there where your view of fair value includes much lower liabilities than what IFRS 17 would typically have. We put up those CSMs to defer those profits and some of the expenses for a period. So if you go down that path, all bets are off, and yeah, you're probably going to be in a world of pain.
Thank you, David. I think the next one relates to a process that a lot of people went through already, specifically in the banking sector, and that's the one we talk about. IFRS 17 seems to be a lot like IFRS 9 was for the banking sector. What lessons are you aware of that we can leverage on our journey? So Shehnaaz, if you can take this for me, and Nevlin, I believe you also have some information that you would like to share.
Thanks, Marnus. So that is quite true. IFRS 17 is for insurers what IFRS 9 was for the banks. But IFRS 17 is also quite different in the sense that it impacts insurers more in terms of the whole way they structure their business, in terms of how they reflect their financial position and their financial performance. So some of the lessons that we can take from there is that we have been given more time with the extension of the effective date, which means we need to use that time wisely. Start earlier to be able to give yourself enough time to identify early on what is critical in the process, what is going to be any challenging areas for you in your implementation, and focus on those first. Data comes up a lot, but also make use of specialists as soon as possible where you need them, because a lot of the skills are not going to be in-house. Have the discussions with your auditors up front as well. Make sure everyone's on the same page with you on the journey. And in terms of the transition approach, it's quite different to IFRS 9, and there's not a lot of optionality. It's a process of elimination only, depending on what you can and can't do, what information you have. So one lesson learned that you definitely can do upfront as a takeaway is to really understand what information you have, and that will guide you on as to what transition approach you can use and information and data that you need. Nev, over to you.
Thanks, Shehnaaz. I think from my experience, so we were involved, well, I was previously involved on the transition on 2 of the big 4 banks in South Africa on the IFRS 9 projects. And I think one of the key lessons that was picked up was, and I'm going to raise it up front, do not exclude or forget about your disclosures. I think there was a lot of focus placed on the model early on. So a lot of people sourced the data, got the data, were able to run the model. They then came to financial reporting and realized, had they thought upfront about the disclosures, they could have built it in upfront and had a much more smoother transition to get to their disclosures. So I think start working with your disclosures already and understand, how do I start sourcing the data for these disclosures? From the illustrators that I've seen so far on the disclosure side, it seems quite complex and needs quite a lot of data to run it. And then I think the second thing is sourcing data is one thing. Sourcing data that is complete and accurate and also governed is something that's very important. So I'm going to link up this question to a question that somebody else asked around data lineage. So effectively tracking all of the data assets that you have in your organization plotting them from the product administration systems all the way through, and understanding, firstly, if I make any changes, what's the impact to the underlying data, and governing the data becomes critical. So even after first-year implementations on IFRS 9, we noted that clients didn't really have data governance procedures in place, which meant that they were using data that was often not complete or not accurate, and then ending up with the wrong answers. So data governance should be built in from the start as part of your process. And then I suppose the most important is saying, well, I've now got all this data. I mean, we're living in a world now where they're saying now data is the oil of the 21st century. So you need to start driving a culture of governance to say that I need to treat my data with the same amount of vigor that I treat my bank account. So if somebody messes up the data, you need to treat it as if somebody's messed up your bank account in order to start driving that culture of accountability around the data within your organization. And if you have all of those right sources of data, I think the next step is to develop an overall IFRS 17 governance method framework over it. I think up till today, we're still seeing over IFRS 9 that companies don't really have a governance process in place for managing their IFRS 9 processes. It's sort of developing now, so build your governance processes as well upfront. And I suppose the biggest frustration with me on IFRS 9, and this is not all organizations, but some organizations, is that they're not actually leveraging all this beautiful data and systems that they've built for broader parts of their business. They treated it as purely a finance play or a finance and IT play. I think it has to start revolving around how you run your business as a whole. So almost say to yourself, how can I generate the maximum amount of value for the spend I'm actually putting on, which is a change which is quite transformational within the industry. Thanks. Back to you, Marnus.
Thank you, Nev. There's quite a few questions coming in on data, and I think you have addressed some of them. So I'd like to just bring in Mark again regarding, I think we are starting to run short on time, so we might combine some of these questions. So Mark, if you can maybe just have a look at and give your view on the following question for me. And that is the one around, I can't find right now. Is there a specific method for assessment significant insurance risk? And what is the general threshold for an insurance risk to be considered significant? So Mark, if you can please take that one for me.
Yeah, sure, happy to, Marnus. I think the first thing that comes to mind is, and people are not going to like this, but the term significant is used quite a lot in financial reporting. However, it is not a term that is defined. And there's a very good reason for that. Significance is pretty much driven by the entity and the writer of those insurance contracts. But not only is it driven by the entity, it is also driven by the products themselves. So you apply IFRS 17 to insurance contracts. You don't apply it to the insurer, you apply it to insurance contracts. So that means you need to assess significance at the level of the insurance contract. And that's the first thing worth bearing in mind. I mean, clearly, the larger the book of business is, the lower that threshold is going to be when compared to your financial statement materiality level. And also, it needs to be disaggregated sufficiently enough in terms of a threshold. Now, for me, significance when it comes to an insurance contract is very much down to first assessing what risks are being transferred between the writer of that contract and the holder of it, and then assessing what that means in quantitative and qualitative terms, but quite probably so more in qualitative terms as to why is the person taking out that insurance contract. I mean, clearly it's an easier one when it comes to P&C or general insurance, but if we were to look at savings products, I think the first thing that one would need to consider is why is somebody taking out a savings product that has an assurance element to it? For example, it could be driven by tax reasons, and it's been structured in a certain way so there is sufficient insurance risk transfer for it to qualify for a beneficial tax treatment. For example, it may be tax exempt or applicable, and a lower rate of tax would be applicable to it. So clearly, if you structure the product in that way, then I think that there is significant transfer of insurance risk. I mean, there are no bright lines, as I said. I mean, we're not talking about 5%, we're not talking about 10%, we're not talking about 2%. I mean, but another example comes to mind, which we mentioned in the slides on the amendments. whereby if you have an equity release mortgage or a whole of life mortgage or a reversionary mortgage, which are effectively all the same thing, then those products are exposed to insurance risk. Now, the person has taken out that mortgage and they could unfortunately pass away tomorrow, in which case the value of the mortgage would not have changed that much, and neither would the property have. So that means the insurance risk transfer may have been insignificant there. However, you make the assessment as at the point in time of writing the product, not 1 day or 2 days later. So clearly, based on longevity and mortality, there is a fair degree of variation in that contract, hence why there is significant insurance risk. And as a result, given the complexities in applying IFRS 17, the board has decided to allow that accounting policy choice. So in summary, it's product driven, but in both quantitative and qualitative terms, with those qualitative terms being including why are you writing this product and why have you structured it the way you have.
Thank you, Mark. I think what I take from that is certainly not an easy answer, an easy one to do. David, I believe you want to add something to that answer and give us a South African flavor.
Yeah, just very briefly. I mean, there are changes between IFRS 4 and IFRS 17, what will be classified as insurance. But in my experience in South Africa, at least, the scope issues around the type of contract, and is this a fixed fee maintenance contract, those are the things that are more likely to lead to a change in classification. Other than that, generally speaking, the rules, the principles, ideas are actually very, very similar. So my default will be that if it was insurance under IFRS 4, it's probably going to be insurance under IFRS 17, unless it's a very specific characteristic or nature of the contract that makes it unusual. Perfect.
Thanks, David. I think to close out, there are quite a few questions on data. As I said earlier, this is the first of 4 webinars that we will be hosting, and the next 3 will be deep diving into each of the subjects, being data and technology, actuarial, and also then the technical accounting. But before we go, I'm going to ask both Nev and Daryl to give us their views on some of the data questions that were raised. And I know we're not going to get to everything, but gentlemen, I think certainly, as we pointed out, IFRS 17 seems to be data. And clearly from the questions, there are some concerns out there. So there's a question here about a binder holder policy that they need to add manually. Someone's asked about cobbling together an Excel spreadsheet. And then there's also a question around, obviously, quite importantly, data governance. And then lastly, there's one about someone acknowledging they've got bad data policies in their system. I don't think we can get all of them, but there's certainly a theme running through all of them. So Nev, if you want to go first, and Daryl, if you can then add to Nev's answer for me. Thank you.
Okay. So Marnus, my view on it is, so I've worked across probably over 15 insurers in South Africa and also worked a lot in banks. I think the thing that concerns me the most for insurance companies is that the level of legacy systems within the insurance companies, as well as the quality of data in insurers, is generally far worse than what the banks have had. And that's a very general statement. There are some that have gotten it really right, and there are some that are really behind. But I think the general assessment is that insurers are far behind the curve compared to where the banks are in terms of data governance and data quality. I think data governance, which is a topic that's very close to me in terms of understanding all of your data and getting it ready. I think IFRS 17 has provided, for me, it's a very exciting standard because it's going to allow the insurance industry to clean up their data and start leveraging it and running some of the insurance companies of the future that I'm very interested in. So I think in terms of, understanding your data and accepting where you are at the moment and understanding the level of effort it's going to take you. To relate it back, I've seen clients who almost in the last year prior to implementation have just come out and said, you know what, I'm just going to go and try to sort it out. They were left with an impossible task and audit deadlines were missed. They couldn't release financials in time. Don't end up going down that boat. To touch very quickly on the binder holder policy data, it sounds like in that example, there's a third-party service provider that's involved. And I'd have actually more questions in terms of, does the data belong to you or does it belong to the service provider, which is probably the biggest issue that you have. In terms of the technology being proposed in the question, I think it could work, but I think the biggest risk that I would find there is to almost try to say, if it's your data held by a service provider, make sure you have access to it and make sure it does belong to you, because with the data holding value, you want to get it and make it part of your ecosystem. So I think that's a big question that's coming around, especially with privacy, the privacy laws in South Africa, with Papaya now being enacted. I think we're down to 10 or 11 months now before it goes live. You almost want to start taking control of your data, even where you have a service provider. So your service provider just provides the service, but you actually hold the data and it belongs to you, because I think that would be far more valuable for you from a business perspective. And then we can then decide how we work around and get the calculation engines running on the actual data that you have. And I can't stress it enough to everyone who has joined us today. Don't neglect your disclosures. It's the thing that causes the most amount of pain and hurt, because you don't want to be doing last-minute fixes at the end. And maybe the last thing I can share is, I think Daryl sort of touched on it a little bit as we were going through, was there's days of having your policy administration systems and having your modeling run in separate environments. IFRS 17 is going to result in that ending. So you want to get as close as possible to having the two systems together. And your data quality issues, now's the perfect time to start the long journey to cleaning up your data, but also building the governance processes to make sure it stays clean going forward. And I think that's a nice summary. I could talk on this topic for an hour, and I'm sure you're going to give me some time, Marnus, at the next session to cover data governance and data quality, which I'm really looking forward to. But in the interest of time, let me hand to Daryl to share some views as well.
No, Nev, I mean, that was brilliant. I think just to put an exclamation mark on it, as Nev mentioned, I completely agree, where most insurers are wrestling with the state of their current data landscape, and it's very much siloed, disconnected, these kind of things. And they've been looking for a number of years, and they've been behind the curve in connecting it all together. And then on the other side of the equation, insurers are looking to jump into the world of advanced analytics and AI to create predictive models and manage the risk and grow the business and find new customers and assess the value of their customers and where they want to go in the marketplace. And so you have these two very different opposing forces, and then you have IFRS 17 in the middle, which actually requires you to connect it up together anyways. And so the exclamation is, it's a huge missed opportunity if insurers don't take this opportunity to connect the data and do it right, do it in a way and do it in a fashion, as Nev mentioned, where data is an asset. It is put into a reliable repository. It has all the governance and stewardship that necessary. The cultural change that will be injected into your organization is done. When you talk about data governance, it's not just about technology. There's significant process and people aspects to the journey, and would encourage everyone to do that. And with doing that, then you can use IFRS 17 as this catalyst to launch you into advanced analytics capabilities and dramatically improve the data maturity within your organizations. And that, from what I've seen, is on many strategic roadmaps within our insurance clients.
Thank you, Daryl. Before I close us out, I'm going to just ask Mark to give you a 1-minute overview. BDO South Africa is part of a wider network, and the insurance team specifically is on a Centre of Excellence for Insurance, and they're specifically an IFRS 17 task force. So Mark, before I close this out and make sure we finish on time, if you would just like to add to my comments. Seem to have load shedding not only in South Africa but also in the UK.
Sorry, am I back now?
Okay, yes you are.
Yeah, I mean, we've got a global team that is looking not only to support insurers in South Africa, but also South African insurers who have global operations. And we do that across technical accounting, actuarial, modeling, data, governance, controls, technology, tax. So we're in the markets where you are, and we're more than happy to help you in terms of successfully implementing a good IFRS 17 program that adds as much value to your business as possible.
Perfect. Thank you very much. So thank you very much for everyone attending. This has certainly been a new experience. Speaking to a screen, I think it gets old for people to say that now, but until you actually present yourself, you realize how lonely it is on this side. For those who want more answers and who wants to reach out to us, I lead the IFRS 17 project in South Africa with the help of all the capable people that was with us today. You can either email myself or Shehnaaz. So thank you once again to Mark for joining us. Daryl, thank you very much. Nevelyn, thank you for your time. And David, thank you very much for your time. Shehnaaz, thank you for all the hard work behind the scenes, and also to the ladies who assisted us, Justine and Londiwe. Have a good day, everyone, and we'll see you at our next webinar. Thank you very much.
Thank you, bye-bye.
Bye-bye.
Thank you, everyone.
Thanks, everyone. Bye.
Bye-bye.